The market has chewed up and spit out all of the buyers trying to defend the daily higher low after that nasty Friday reversal, and there's definitely some more downside indications we need to be aware of, and we'll talk about them in today's episode of the Weekly Watchlist. So let's build a game plan that's based on logic to determine whether or not the odds have increased for a continued breakdown here, or if we should keep fighting for our SPY daily higher low to hold. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we're certainly looking at a solid red-bodied bar with just a little bit of an upper wick on top, of course, indicating some sell-side pressure near the highs of the weekly range, and the sellers do a great job of closing fairly weak at the bottom of the weekly range. So overall structure does go to the sellers this time around. If we think about location on the bar-to-bar count, we do have ourselves a very nuanced lower high, as well as a similarly nuanced higher low, giving us a classic double inside bar setup, which is extremely rare on the SPY weekly time frame. However, the implications are still very much so the same. It's extremely neutral because we have not expanded range in either direction, be it up or be it down, over the last 2 trading weeks. So with that said, maybe we can fall back on structure and say, okay, the bears have an upper hand from that perspective. However, I think we can add in a little bit more context with this weekly range that we've been using to try to navigate this pullback in the first place. Remember that prior resistance also acted as resistance in the upper wick of the green inverted hammer from back here. On the first inside bar, the lower wick was at the bottom, of course. That's why it's a lower wick, and that would just imply that the buyers tried to step up and they tried to defend that level, testing it from the top side down. In last week's worth of trade, that's no longer the case, and the upper wick obviously is at the top of the bar, which would indicate that the buyers are unable to get prices up and over this cluster of highs here to produce the weekly equal high closer towards that 459 area. That to me is a little bit more of a bearish indication, and you could even make the argument that we've closed back down underneath the top of this original range, and we can certainly see that on the SPY daily in just a moment, closing beneath 445. So the threat into the coming week's worth of trade is that we make the rotation back down towards the bottom of this original range, which puts into play the neckline of this area right here. And as we know, we've talked about the potential threat of a weekly double top, and that neckline is the last higher low in the overall trend sequence around 432. Remember that we have lows, higher lows, higher lows, higher lows. Well, these were soft lows initially, but these are now higher lows since we flipped into a daily downtrend and we were pulling back from a higher high, right? So the threat is the precursor of the move to get to the neckline in the coming week's worth of trade. That's your downside if we break down from this inside bar, double inside bar range. If the market can stay above, if there's a prompt reversal early on in the week and we're consolidating up here, it continues to remain neutral, and the only bullish indication is if we can breach those highs to get to the weekly equal high and keep the uptrend sequence alive. Before we throw on some anchored view apps, again, I want to remind you that this weekly area right here is far different than if we isolate this weekly trend right here. This is a very strong illustration of a weekly uptrend, and this is much more so a weekly neutral trend with lows, equal lows, highs, possible lower highs, and we find ourselves in the midpoint of that overall range. If we can spend more time in the upper 50%, it feels more bullish for bull flag consolidation. If we spend more time in the coming week's worth of trade, or even next week in the coming month's worth of trade in the lower 50%, it certainly feels more like a threat for a breakdown of the double top neckline that we were just referring to. Let's take a look at the anchored view apps and see if these align with or contradict the analysis performed. And certainly our anchored view app from the AI Mania breakout is in play once again. And the issue is that usually the first test is the best test, and also coming in off of a lower high lowers the amount of confidence that this anchored view app will hold. So currently, we're still above the entire cluster, but it certainly seems like a threat where if we do break down, the neckline is in jeopardy, no longer holding that as a strong area. Let's take a look at our volume profile and see if this, again, aligns with or contradicts the analysis performed thus far. And I think what we'll find is that, again, most of these data points align with this as a key level that is going to act as a gatekeeper. The high volume node that we're contending with is the top of the original weekly range that we were just referring to. And if we can break down underneath it, it then has the opportunity to act as resistance. And maybe this turns into a descending triangle, not just a double top, furthering the possibility of a breakdown. What would be the target on a stronger weekly breakdown? It's right back to here, the monthly possible higher low around 418, 420, and just the neckline of the inverted head and shoulders from the monthly time frame chart, or even if you just prefer the weekly, it's the ascending triangle breakout point as well. So that's what we see from that perspective. Let's take a look briefly at our Fibonacci's, because these would still align with the idea that we don't want to jump the gun on changing our tone yet for an overly bearish stance if we're still above the massive area of confluence, which, as we know, is the 61.8, the 38.2, the 61.8 from all of these different perspectives, still hovering right around our 430 area. So before we change our tone for a weekly downtrend, we're still neutral if we're hanging out above the neckline of this as a double top. Since we already have the potential for a lower high on the table, when and if we break that neckline, we will of course concede the point that yes, we have flipped into a weekly downtrend. Let's take a look at some more evidence on the daily time frame. So let's first evaluate the expected move for the week. If you're not familiar with this study, check out the video tutorial in the top right hand corner. If we're contained by the upper bound, the number is 449.37, and that's a very nuanced lower high from here to here, or a more obvious lower high from here over to here. If we're contained by the lower bound, the number of course is 437.37, and that once again is maybe a nuanced higher low, maybe a nuanced higher low from here to here, but overall with the more obvious lower high and maybe just equal lows on par with what we've had back here, I would say expected move is neutral at best, probably a little bit more bearish considering everything that's going on here. What about our SPY daily time frame trend? This is really where the battle is coming undone, right? If we do something that looks like this, that shows the opportunity for your weekly lower high that we were just talking about, and we've even got a nuanced daily lower high from here to here. But you can counter this argument with something that looks like this as a daily higher low, right? And really the range is compressing and the trend isn't all that clear because you have lows, technically a higher low, and we're still pulling back looking for a higher low. But if you're a shorter term trader, I think it's worth focusing on the more relevant price action, this as a lower high, and this much more so as an equal low. And what do we know about downtrends? They require lower highs and lower lows. So all it's going to take for me to start feeling like the SPY daily trend is down is a lower low being produced early on in the coming weeks worth of trade. I think it's worth being mindful of the support trend line and still the opportunity for some type of daily higher low, even if it's not picture perfect at the neckline of the level we've been talking about for quite some time, 445. But that's the dilemma of the SPY daily time frame chart right now. It's the competition of the weekly lower high, the daily higher low, and that's why you're seeing all of this push and pull. I do believe that if we take a look at pattern here, the response from the buyers around this area has been extremely lackluster. First and foremost, if we look at Monday, gap fill reversal attempt. Tuesday, right back to Monday's high, no follow through in the upward direction. Wednesday, holds on to the 445. Thursday finally breaks out, but what happens on Friday is it's all undone, and we close underneath that key level at 445. So think about all of the buying pressure that was exerted, all of the effort that the buyers had to put into this market, trying to keep it within this 3-day balance above the key structure, which was 445, to finally see a breakout on Thursday and have all of it wiped out into the Friday close. It feels as though the buyers are a bit exhausted, and once again, that would sort of align with the idea that the most recent lower high and equal low could produce a daily downtrend as soon as we get a lower low underneath 443.25. Downside targets would have to start becoming 441.25, 438.75, and then the lower bound of this week's expected move at 437.37. If there's a sharp reversal early on in the coming weeks worth of trade that somehow gets us back up and over 445, I would tend to be more neutral in here on the daily time frame chart, noting that overall, if you want to start treating this as a range, where are we? We're just in the midpoint of that range, right? Things are definitively more bearish if we can get down in the lower 50% and a little bit more constructive if we can get into the upper 50%. Based on the evidence here and the lackluster response from the buyers, I'm not convinced that it's going to be an easy time recapturing 445. You'll also notice that we've definitively failed now our daily 50 SMA. Again, there's your recapture right back down to underneath, and you can clearly see how Friday's session was much more bearish in terms of the momentum and the range that was traveled. I get it was an OPEX, it was a quad witching, but much more bearish as compared to the Thursday move in the upward direction. We get a little bit of a gap fill reversal, closed near the top, but there's some resistance in that upper wick, whereas on Friday it was just lower, 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 lower all day long. So let's take a look at the hourly time frame chart. and really build out our game plan for the coming week's worth of trade. Again, if we just think about logically what unfolded here, you certainly see your gap fill reversal on Monday. Buyers had to put in pressure here. On Tuesday, we opened fairly weak, but okay, the buyers try to get it back up towards Monday's highs. It fails there. Obviously, the Apple keynote is somewhat to blame, but we find ourselves lower. So once and twice, the buyers have had to exert effort. You can see the same thing on the Wednesday session, trying to recapture only to fail into the afternoon. Thursday is a gift, right? Thursday is a gift. And if the buyers were unable to capitalize on this gift, and now we see this clear overtake basically from the sellers, it to me would seem as though the buyers have thrown in the towel and they're no longer really interested in trying to defend this daily higher low. Pair this with some of the fundamental data that we got, obviously in the last week's worth of trade, that inflation continues to sort of rebound. Not really looking great if we start to put the pieces of the puzzle together. So how do we want to act as we move forward into the coming week's worth of trade? We certainly want to be mindful of 443.25. Any consolidation in here is ultimately bearish, right? Because we have 445 acting as resistance. That's your weekly key level that we were discussing. If we're underneath it, it's the catalyst to get back down towards the weekly equal lows, closer towards that 432. Again, that's a breakdown over time. So bearish consolidation takes place in here. If we even get above 445, I would be hesitant to be on the bull side of the market if we're underneath 447. I would say that it's bearish consolidation in the grand scheme of things, right? Because we've got ourselves an equal low. We're coming in off of some sort of daily lower high. Any consolidation in here just sets up another potential lower high. And the reason 447, remember it as 446.85 into the end of last week, we've adjusted slightly, but that represented the opportunity for the buyers to run away with it over this hourly lower high, right? We had something that was looking like this. We finally produce a higher high from here to here on the hourly, and that fails. So again, tried to defend. It all falls apart. That's where the breakdown stems from on the Friday session. So if we're under 447, yet above 443.25, this is the ultimate bearish consolidation. This is still bearish consolidation, looking for breakdowns. We talked about lower targets. And then if we can get some sort of higher low over 447, maybe we will reevaluate what's going on. But it seems like a bit of a stretch given psychologically what's taken place over the last week's worth of trade in this overall area. If you're going to make the argument now for a higher time frame double bottom to rinse and repeat, you've got to get up and over the neckline of that pattern, which is closer to 450, which seems unlikely considering it's the upper bound of this week's expected move, as well as where we clearly found some rejection from the buyers as we attempted to move into this overhead supply on the Thursday afternoon. Let's take a look at the anchored VWAPs. Do these agree with or sort of contradict the analysis in here? And I would say that they largely agree. You can clearly see a strong band of anchored VWAPs sitting around 447. Thus, it's very difficult to be a buyer with more confidence if we're underneath that band. You could make the argument that we're consolidating in this general zone because you technically have this lower anchored VWAP there, but it's definitively more bearish consolidation than anything else. If we can re-clear it, something like this, maybe we change our tone. Remember, that's a back pocket situation considering the psychology of what's unfolded in here. And more likely than not, if we get sideways consolidation underneath 445, it's losing the bottom of the anchored VWAP band as well. A breakdown through the equal lows sets up your move for the downside targets that we were just discussing. Let's take a look at some more supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, what we want to do is compare and contrast Thursday and Friday. Volume flows were substantial and positive on the Thursday breakout. So why was it that it was so easily undone on Friday with substantial outflows, breaching negative 300 million into the close of the session? Net flows on the week did close out slightly negative, but nothing to write home about. If we think about the advanced decline line, again, really strong correlation up in trend higher zone on the Thursday session. Why was it that there was no follow through or no attempt even from the buyers to defend the work that was done on the Thursday session with the advanced decline line drifting lower into Friday's close? The same exact commentary on our cumulative builds from the tick down below, just a complete Uno reverse card into the Friday session. So in my belief, if stronger buyers were truly going to be involved in the market, they would not have allowed for a substantial reversal into the Friday close like this. So it would speak to weakness in the buyers who are committing on the Thursday session, and the fact that the sellers closed weak at the weekly lows and daily lows as well sets up the possibility for momentum follow through early on in the coming week's worth of trade. Market profile is always going to be Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. What do we see here with value area and point of control, specifically on the Thursday and Friday interaction? Notice that on Thursday, value area is finally breaking to the upside. It was clean to the upside outside of a contained value from the Wednesday session. Notice also that your point of control was more centralized on Wednesday. Clearly, point of control is higher in the profile on Thursday session. So once again, looking pretty decent on Thursday for the breakout, and the buyers remaining somewhat strong. So again, it begs the question, why were the sellers with ease able to put in a decent excess high on Friday, close value area overlapping to down of the original value that we were referring to on Tuesday and Wednesday, and the point of control closes extremely weak at the bottom of the overall range? It just wouldn't make sense that stronger buyers are looking to defend the daily higher low, and instead this to me stacks up as a bearish data point. Jumping back on over to the platform to evaluate the weekly performance of our sectors also starts to reveal some cracks in the armor. If we look at the top of the list here, the XLU for utilities was the top performer, up 2.9%, and that was even better as of Thursday's breakout. So utilities leading the breakout was the first indication that this was not setting up to be a follow-through move, and we talked about this over on our Twitter feed. If you're not following us on X now, as it's called, go check us out over there, Trade Brigade Co. We'll put up a screenshot now. But beyond that, notice also at the bottom of the barrel, it's the XLK, the heaviest weight risk-on sector, really getting beat up, down 3.1%. So as we attempted to break out of the SPY 3-day balance range here in the upward direction, again, we always have to remember that price rules all. So the break was looking good initially, but some skepticism started to creep in when we considered the fact that utilities were outperforming on the week. So posture is definitively defensive here as we move into the upcoming week's worth of trade. Let's take a look at some of these structural charts and evaluate what's going on. Remember that in utilities, we sort of made mention that on the initial move in the upward direction, it was possible for a daily lower high here. Obviously, on the Wednesday close, we're firmly up and over 63.75. Now there's clearly the opportunity for a daily higher low to pull back and respect this level at 63.75. That would be a bearish indication if this inverted hammer ultimately does resolve in a pullback and we find support above this area right here, especially if the market's going sideways and has not definitively broken down underneath that 443.25. Finding support in utilities would be a defensive move. It would seem to threaten more of a risk-off posture for our markets. The one thing that we can say was quite positive this week was financials actually putting in decent consolidation into the close of week up and over its neckline of this as a potential higher low double bottom. The more time that we can spend over 34.75, the more it cushions any blows that potentially happen in the S&P in terms of breakdown. Obviously, if we slip back down underneath, that starts to become much more of a threat for a weekly lower high. And if we attempt the weekly equal low, which would be down here at 33.65, kind of does not bode well for any bullish continuation out of the S&P 500. Next up, communications, honestly not bad on the week, really more so sideways than anything else, up roughly 0.36%. So unchanged in the midpoint of this as a range. I would point out that it did, of course, make a higher high. Friday is a bearish engulfing bar, so if it does continue to pull back, I would remain neutral in this overall area between 68.10 and 66.75, also continuing to defend an upward sloping daily 50 SMA. More constructive if we're up here, and obviously more bearish if we slip this level, remembering that it was ultimately the neckline of the double bottom back here. Let's take a look at the XLP for consumer staples. Not really doing anything impressive. I would say that the threat for risk-off defensive posture is far more a threat over in the XLU utilities. So back down at this level, again, really doesn't strike me as much of a concern right now. Let's take a look at real estate, sideways inside the midpoint of its range in here. Nothing to write home about. Here's the XLY, much more similar to the XLC in my estimation, still holding up above a key level, more so sideways on the week than anything else, closing basically flat in here. As long as it wants to maintain its daily 50 SMA, as long as we can get further consolidation over 170.25, is there not the opportunity for a daily higher low that does something like this, and we would be pulling back from a higher high in the overall trend sequence. So this is saying, again, that weekly patience that we were talking about is still paramount if we're above 170.25, remembering that the XLY is a heavier weight risk-on style sector. Here's the XLV for the healthcare sector. Really the flattest on the week, up 0.14%. Nothing burger, right? It's trying to resolve this area right here. The more time it spends underneath 132.65, it's definitely bearish pressure for the S&P. But remember, this is not threatening a big break to the upside. And because this is D for defensive, we don't want it exhibiting leadership, but we also don't want it falling off of a cliff. So this little counter trend move here, which sets up a daily lower high, is actually quite nice. And once again, softening some of the blows that we're seeing over in the S&P. If it does break down and it starts to make new lower lows underneath underneath 130.25, that would be a larger red flag for continued downside, basically full-blown correlation downside over in the S&P as a whole. Next up, let's take a look at the big boy, the XLK, what's going on with the tech sector, the heaviest weight risk on sector, and obviously this is where the pain point is for the market, getting a big close on Friday underneath 170.25. So is this not a weekly lower high? It absolutely is. Is there an opportunity for a daily higher low still? Maybe, but you're definitely dealing with much more of a short-term downtrend in here, and with the loss of that as key support at 170.25, because as we know, it was the neckline of this inverted head and shoulders. It seems like a larger threat for the S&P, once again, remembering that the tech sector is the heaviest weight risk on sector. So this breakdown certainly provides the threat that any rally attempts can produce a lower high underneath, and that would keep us bearish on the S&P. The saving grace for the S&P is if this turns into a look below and fail, and we rotate back to the top of this range, we could start to consider this maybe a 6 or 7 day balance. We didn't really make too much progress higher. We didn't make too much progress lower until breaking down on that Friday session. So if we get an early recapture early on in the week, Monday or Tuesday, and then a higher low back above 170.25, maybe there's an opportunity for a look below and fail, but that's wishful thinking, especially with the incredibly weak close on the Friday session and considering all the other data points that we'll look at in today's episode of the Weekly Watchlist. So overall, XLK does strike me as a threat. Industrials making a new lower low, opportunity for a lower high on any sort of rally up against 107. That would be a bearish indication. Energy, lighter weight sector. We don't want it leading any market rallies. Obviously, we're not dealing with a market rally right now, so this pullback does not strike me as the end of the world. Certainly a weekly higher low opportunity over 90, and this is building out as an uptrend. As we know, that's going to continue to put upward pressure on inflation. Last but certainly not least, really lightweight sector, XLB for materials, sideways balance. It will be upward pressure mildly because it's so lightweight, up and over 82.65, and we're much more concerned about full-blown correlation to the downside if we get a lower low underneath 80.25. Here's the sector ratio grid. If you're not familiar with the screen, check out the video tutorial in the top right-hand corner on how to set this one up. Overall, you can see the weakness creeping in from the tech sector here, which we just outlined on the structural chart itself. XLV really remains sideways, so it's not a full-blown flight to safety yet. Strong outperformance from the XLF on a relative basis compared to the S&P, but as we know, it kind of got that consolidation over its key level. Watching for that to help the overall risk-on look, but the XLY move here to produce a brand new higher high really strikes me as the main takeaway from the risk on cohort up at the top. XLC also produced a higher high, but notice also that we're getting the creeping in of risk off and the creeping in of risk off. I think that this aligns with the idea that on the weekly time frame chart, we're kind of in the midpoint of that range. We want to be patient. It's not a full-blown risk on look. It's not a full-blown risk off look. I think if anything, we're getting that compression of range. The daily trend line resistance and trend line support really supports that compression, and the sectors are fairly confused with a minor edge in terms of net performance towards the risk offside as of last week's close. Another big deal is sort of looking at the specialized ratio between the XLK and the XLU, a substantial downward move. Now, we are pulling back from a higher high, but to see an equal low like this at the pace in which we've seen it does not strike me as a warm and fuzzy feeling. Ideally, this would have pulled back and it would have found a higher low here, which it attempted to do in that little interaction right here, but obviously it could not hold on. So this does strike me as a bit of a threat for the risk on revival that we've been talking about in the past couple of videos. If we take a look at the XLY over the XLP for consumer staples versus consumer discretionary, there we go, certainly produced a higher high and much more of a mild pullback. So this would certainly still speak to the patience play that we've been talking about in terms of the weekly range. What about our good friend, the dollar? You can certainly see that we made it to our final destination at 105.65 in terms of the look below and fail pattern. Coming back into this is an overall range, always target the top end, and we've hit that as a target. So overall, there was a delayed reaction, it seems, in equities down below, with the dollar making a substantial stride higher on the Thursday session, and then the market reacting lower on the Friday session. So that's kind of a bit perplexing to me, watching this relationship, continuing to see how this evolves around the top of the range. If the dollar can start to consolidate, maybe it leaves room for more of a sideways market as well. If we just blast right through the top of the range at 105.65, I mean, to me, that's kind of a red flag that, hey, it's very unlikely that we hold on to the daily higher low that we were describing earlier. What about the gold contract? How does that feel about all of this? And if we take a look here, 1950 is in play early on in the week, and it seems as though the relationship's starting to change just a little bit, right? Because you have gold higher and the dollar higher. The only circumstance in which which I can see that happening in unison is if people are starting to view gold as a defensive posture against equities over here. And, utilities outperforming on the week would start to align with that idea if people are going to start rippling it out into hard assets like gold potentially. So watching the GCs at 1950 in the coming weeks worth of trade, if we're underneath, I think it speaks to more of a sideways market down here. If it really starts taking off to the upside, that would be more of a red flag. That to me, people are focusing on this as a safe haven asset. Whether or not you believe in that is totally up to you, but that would be the indication from the chart. Let's have a look at the TNX and see what's going on with interest rates. This is a must talk about because we're sitting right back up at that September or October high of 2022. If we break out here, which is totally reasonable after a rounded bottom, maybe even a cup and handle, if you will, if you want to call this the handle over here, even just call it for what it is, it's an ascending triangle. A breakout here continues to put downward pressure over on the tech sector, which makes it fairly difficult to build the argument that your daily higher low is going to hold. As we pulled back, I suppose, if anything, that's when the market should have rallied, and we did see that indication on the Thursday gap down, but now that we're back up at this breakout point, certainly seems like a threat, especially from a technical perspective, noting that the breakout would be valid here up and over 43.33, that, hey, look out below in equities if we get the big breakout over in the TNX. Let's have a look at the inverted ZT just to get a sense for what's going on with the Fed tracker tool. What should we be expecting? It's still very likely with the inverted ZT being sideways in here that the tracker tool is suggesting somewhat of a pause, even with the higher inflation reads. Let's take a look. So no surprises to see increased odds of a pause here for the meeting, which is going to take place on Wednesday, and lower odds of a hike. And the same thing holds true even if we go out to the November timeframe. After getting the CPI data on Wednesday, you can see compared to a week ago, higher odds for a pause in November, lower odds for a hike. Similar story out here even towards December. Higher odds for a pause, lower odds for a hike, and perhaps just the easiest illustration is the whole higher for longer at 525 to 550 basis points from our Fed. And we'll get the FOMC on Wednesday, and I'm very curious to hear what Jerome Powell has to say about the resurgence of inflation, because obviously the CPI came in hotter than the expectations at a 0.3 versus a 0.2 on the expectation on the core month over month, and more so on the year over year, we got a 3.7 versus the 3.6 expectation. Even PPI on the month over month here was a miss, 0.7 versus the expectation at 0.4. The one saving grace is that inflation expectations actually fell. So consumers are feeling like, hey, maybe we're moving in the right direction, right in the face of an uptick, of course, but 3.1 versus prior at 3.5, which is fairly interesting. If we go out to this upcoming week, obviously, we know that we're dealing with the FOMC on Wednesday, and that will be a big deal, expecting that pause. But more importantly, what does Powell have to say about the resurgence of inflation over here at his 2:30 infamous press conference? One thing that I think is going to come up as a valid talking point is just that a couple of months don't necessarily make a trend. We're moving in the right direction here. Jerome Powell, in the early stages of inflation winding down, was a big proponent of saying 2 readings does not make a trend. That was from here down to over here. Now, we definitely have more than 2 readings heating back in the upward direction, but does he make some sort of comment about, just a couple of reads don't necessarily make a trend? Is this still overall moving in the right direction? That's probably what I believe he falls back on, but he will be pressed fairly hard about that in the conference that follows. If we go back on over to the platform here, just to take a look at the earnings calendar, not much to write home about. It's really going to be the FOMC, but maybe keep an eye on General Mills from a consumer perspective and FedEx from a transportation perspective. What does the market's appetite for risk look like as this hot CPI inflation print comes out? Notice that the TLT ratio to the S&P saw a small uptick on the Friday session, but it's still well underneath our downward sloping resistance trend line, not speaking to any flight to safety here, and still strong appetite for equities down below. If this relationship is broken, we can take a look at something like short-dated bonds in relationship to one another, and this tells a completely different story, noting that we are sitting at equal highs in these short-dated relationships, which would speak to a lack of confidence on the long end of the curve, and thus a lower risk appetite for long-dated, riskier assets such as technology stocks, right? So overall, this would not bode well for continuation in the upward direction or holding on to your SPY daily high or low. Let's take a look at credit spreads because, again, it's a lot of conflicting evidence right now as we're navigating the juncture between the weekly potential lower high and the daily potential higher low. Credit spreads actually are moving in the downward direction, which is the proper direction here on this particular ratio. So it's small steps in the right direction, but notice that we certainly don't have any big time lower lows. So it's really more neutral than anything else. There's the opportunity for this to threaten a move higher, higher, threaten a move higher. We just don't have it yet. We'll keep it as a back pocket situation. What about the HYG in isolation? What is this showing us? This is actually more of a bullish data point. Whether or not you can believe it is a different story, but you can see the HYG in isolation is providing some sort of higher low as equities down below are getting an equal low. If this would be any suggestion of a higher low here in equities, you probably need to take this out and you need to take this out for a rotation closer to this head of what was previously considered a head and shoulders, possibly, right? You need to get here in the HYG to really have more confidence and say that, yes, it is a bullish divergence for equities down below. What about Bitcoin? This is worth bringing up just because of what's going on from a risk appetite perspective overall. Notice that Bitcoin tried to make some new lower lows after this breakdown back here, but did produce a weekly hammer close to the bottom of this range. If it can get some more follow through back up into the range, obviously it's not one for one down here, but overall, that would speak to the appetite for risk actually improving, unless people are looking at Bitcoin as a, quote, flight to safety, which at this point, I would be very hard-pressed to call it that, right? There's really no value in it other than speculation at this point in time. We don't have mass adoption yet, so I think that argument's a bit far-fetched, but watching that closely as a minor indication overall. How about the market breadth? It's certainly enough to get us feeling a little bit more bearish again about our overall market, with new highs versus lows making a negative impression again on the week-over-week move. And just remember that we don't necessarily need the strongest positive indications in the early stages of a trend recovery, but we cannot really afford to spend more time in the negative territory, which of course is what we're starting to do. This really needs to get positive again and stay positive for the foreseeable future for more of a constructive look. Let's take a look at the SPX A200R, zooming in on this weekly time frame chart. A little bit of an uptick this past week, however, still underneath the 50% mark, not feeling great about that. And the most dangerous, of course, the SPX A50R on a daily time frame chart finds itself back down towards the equal lows here after a lower high rejecting our 50% mark. And also, this is as the market is going sideways. Notice that in the end of week on that Thursday breakout to the upside, right? If I just zoom in on this, roughly equivalent. So Thursday gets a breakout, right? Notice that we did not see any material improvement on the SPX A50R, even as we're roughly, right, we're better than back down over here on a relative basis, right? If I just hover my cursor, you can see that this is roughly the equivalent of this. As we get that Thursday break, it's really not that we get a big improvement out of this. So breadth across the S&P 500 is not really improving as we're trying to hold on to the daily higher low. Once again, this would speak to a bearish data point. Let's take a look at the RSP equal weight S&P 500, and you'll notice the clear rejection back down underneath that 148 level. We talked about how after this lower low, it was very, very plausible that a lower high could be on the table anywhere at or around 150. We didn't even make it there on the Thursday breakout attempt, right? So this speaks as a bearish data point as well. And lastly, our Dow divergence is still very much so in play, with the industrials trying to hold on to the higher low set, with the transports making a lower low, speaking to bearish divergence and bearish odds for our broad market. And if you're still a market bull, you're probably preaching about volatility. Look at the VIX staying sub 15, even with that Friday breakdown. It does strike me as being fairly impressive, actually, on the bull side, meaning volatility is contained. And even if we take a look at the VVIX, volatility of volatility, it remains comfortably lower in this as its overall range, not sitting down below on complacency zone, which is 75 and below. And there's certainly no threat of a move up and over 103 at this point in time. So volatility is actually quite comfortable with the breakdown that unfolded on that Friday session. Let's take a look at the VIX futures, the volatility futures, and see what's going on from that perspective. Backwardation or contango, certainly in our contango here, working towards a minor step towards backwardation, but still so far removed from the zero line that it's difficult to say that money managers are fearful of that backwardation coming and taking hold, still willing to allocate capital under the current circumstances. Same thing in the 9 versus 30-day VIX, and your one-day VIX as well is no longer following this trend line higher. As a matter of fact, rejecting it on the, what would that have been, Tuesday session, and remaining underneath, actually printing some lower lows on the early stages of this week's session. So overall volatility stacks up as a bullish data point. It's really about balancing out all of these conflicting indications, with the weekly neutrality being in the midpoint of that range. I think that we'll learn something when we can break the weekly double top neckline, or if we move back up towards the equal high. What about the NASDAQ weekly time frame chart? You can certainly see a very similar picture compared to what we just discussed over in the S&P, with maybe a little bit more mild of an upper wick, but nonetheless still a double inside bar, and the possibility for a weekly lower high. If it is going to turn into a weekly double top, we know that we need to be underneath the neckline, which is closer towards that 357.50 mark on the weekly. If we do see a stronger breakdown, we have much thinner structure to retrace on the AI Mania breakout from back here. That would bring you closer towards that 324 support level on a monthly possible higher low. Let's take a look at the QQQ weekly anchored view apps and see if we can learn anything else from this perspective. Similar commentary coming into the anchored view app on a second test in short proximity of time does not give us as much confidence, especially coming in off of a lower high. And again, closing week on the lows would suggest that if we do see a breakdown of this as the equivalent horizontal level to 445 in the SPY, in the QQQ it is 369. We really know it as 372, the double bottom neckline. We'll talk about that on the daily in just a moment. But if we break down through that and we spend more time in this lower portion, that certainly would be the equivalent of the more bearish consolidation we discussed over on the S&P. You can see the larger breakdown to get towards this area back here. What about the volume profile on a weekly time frame chart QQQ? If we have a look and take a little bit of a zoom here, what we'll notice is that this high volume node is still underneath us, and that can act as support. So there's a little bit more wiggle room on the downside for our QQQ to catch ourselves for a continued higher low. But once again, you're really more so balancing out in this as a sideways weekly range. And remember also that this move was just absolutely incredible. Is it totally reasonable that the NQ, the NASDAQ as a whole, could get some mild consolidation, some sideways balance for a couple of weeks to digest this? Absolutely at this point in time. If we bring out the Fibonacci's to do something similar to like what we did in the S&P, we know that the major confluence level is closer towards, we want to come from this low first. If we could get a click thinkorswim, thank you very much. Here and here, we know it's 350, right? If we do this and then come from here up towards here, it's roughly that area around 350 as your big confluence mark. So if we break the neckline of this possibly as a double top, we can go to 350, and then the more bearish indication is getting more price acceptance underneath for the deeper rotation towards that 325, about 25 points worth of downside activity available there. Let's take a look at our daily time frame chart on the QQQ and see what else we can learn about the price action here. Zooming into the daily, here is the expected move for the week. Notice that the breakout on Thursday, first and foremost, was not as aggressive as what we saw over on the S&P side of things, and obviously we saw that muted XLK, which is a great mirror basically of our QQQ. So, clearly the opportunity still to produce an equal or even lower high if we're contained by the upper bound of the expected move at 378.07. If we're contained by the lower bound, clearly it's a lower low from here to here, but it is maybe a higher low still from here to here. So balancing that out, I would be more neutral on the expected move, maybe bearish just in the sense that we're not also forecasting some sort of higher high. The options market is not pricing in a larger upside move. And as a matter of fact, right, if we continue to balance out the more relevant daily trend, you get some sort of lower high, again, your equal low. There's much more room to the downside just based on that expected move from that perspective. So here's the range. Again, your lack of follow through on Thursday is kind of a big tell in terms of the weakness over on the S&P and not really trusting that breakout of the 3-day balance range. You can see also on the QQQ, we closed fairly weak on Friday underneath that 372. Just as a reminder, that's your neckline, of course, of this as a double bottom. So is there still the possibility of a daily higher low somewhere around here? It's absolutely on the table, but we're less confident in it now, 100% less confident in it now that we do have the close underneath 372 and the lack of follow through on the Thursday close near the highs after attempting to make a higher high. And again, just relative weakness compared to your S&P on a location standpoint. Let's take a look at the hourly time frame chart, see what else we can learn. Again, this is much more clearly a balance range, and we would have similar comments, right? Definitively more bearish, looking for lower highs and bear flag consolidation on failures to recapture 372, looking for downside 367. Remember that we have weaker structure, thinner structure to retrace compared to the S&P, so the short might actually be easier on the QQQ, the NASDAQ side of things for that reason. If we do come back above 372, maybe you could call it a look below and fail, but I wouldn't hold my breath on that particular indication. The target would be the top of the range at 375.75. That's exactly where you broke down from on the Friday open. And the only time to be more bullish on this market is really if we can recapture that open and get some sort of hourly higher low and price acceptance over 375.75. Other than that, not really seeing the strong evidence that buyers are ready to step it back up and regain control of the smaller time frame chart. I would argue that this mostly agrees. You're getting some chop, and I wouldn't be overly concerned with the anchored view apps chopping around in this range. If we can clear them to the upside, that's obviously more constructive. Staying underneath the major cluster and flushing this opens to the downside. downside. And once again, 367, 364.75, then the lower bound of the expected move at 363.45. What about the market, internals for our NQ side of things? Same old song and dance. Aerosmith's really getting played a lot around here recently, with a negative 400 million read getting hit on the Friday session, moving into the trend lower zone on Friday session as well, and the cumulative build also reflecting a just complete wipe away of any attempted bullishness on the Thursday session. Then last but not least, for our NASDAQ, let's take a look at the market profile. Great excess high, value obviously shifts lower, and it's definitively underneath the value from here. Here, this is the entire week, right? So here is the value for the week, and value shifts lower on the Friday session, completely underneath everything from the Monday, Tuesday, Wednesday, and even Thursday. Breakout point of control is also extremely weak at the bottom. Here we have a lack of material excess at the bottom. It would seem reasonable that this obviously stacks up as a bearish indication. IWM Russell 2000 weekly time frame chart. What do we see over here? Structure and location, also very bearish. Small red-bodied bar, a little bit of a lower wick, a little bit of an upper wick, but nonetheless, I think that the same commentary from last week really applies to the small caps here, possibly being the canary in the coal mine this entire time for the broad market, just unable to escape this as a range, failing here. Lower high is in place from the weekly, sitting on the equal lows. A flush here would really not be all that surprising. If it does take us back down towards the bottom end of the range, obviously that is bearish pressure for our broad market as a whole. So really watching the Russell equal lows on the weekly here, if we break down underneath, kind of spells a threat for the broad market as a whole. Let's take a look at the anchored view apps, because once again on the weekly, this just shows the clear rejection on the reattempt to get above the all-time high anchored view app, and if we break the equal lows, it's failing the October low anchored view app. The only saving grace on the Russell weekly time frame chart is the volume profile, which would suggest that there's strong volume support closer towards this, 173, 175 area, the bottom end of the weekly balance. I wouldn't bank on it, because if we do start to slip that, what would that suggest? Anybody who's been building a long position at the bottom of this range as a range trader, just playing ping pong back and forth, if those people start to become underwater, obviously there can become a lot of sell side pressure with this acting as overhead supply. So just because the volume support is there does not necessarily mean that it is a bullish indication. Let's take a look at the daily time frame chart for our Russell 2000 and see what's going on in the small cap land. A little bit of lag here on the mobile command station with Thinkorswim, but we've got the job done. You can certainly see that we have 100% retracement, bear flag consolidation back down on the lows. We talked about it last week, the volatility that's here, and just the wild nature of small caps right now makes it incredibly difficult with the push and pull between the S&P being caught in between weakness in small caps and the attempt for strength over in the NASDAQ side of things, at least earlier on in the week, as we were seeing some relative moves higher that were stronger in the NASDAQ. That made it pretty difficult in the S&P. So overall, this consolidation does strike me as weak. You can see a look above and fail on the range here. As a matter of fact, let's just take it down to the hourly once we point out some downside targets. Obviously, your equal low breaks on the weekly if we start getting price acceptance underneath 183. Next target down below is the bottom edge of this week's expected move, closer to 180.25. Then there's a minor gap to close down here around 177.50, down towards 176.25 as a target. If it does move higher, I really would struggle to see the upside out of small caps unless we can get somewhere close to the right shoulder highs of this head and shoulders pattern, right? One of the threats we talked about last week was if we do breach this neckline of the head and shoulders, kind of kiss this thing goodbye. The measured move, of course, always being from the head to the neckline, would suggest that there's plenty of downside room to fall towards the bottom of the weekly balance. Let's take a look at the hourly time frame chart now, though, and see what we can see. So once again, if this was a balance range, which it absolutely was inside of a prior balance range this Thursday, as a look above and fail, made it to the bottom, hit the target. Now just kind of being patient. If this is going to resolve in the downward direction, once again, you need more price acceptance underneath that 183, and you're probably trading for downside outcomes. Let's take a look at the Russell internals. Again, bearish across the board on Friday here. A little bit of a rebound on the Friday out of the advanced decline line, but still nonetheless working towards trend lower zone throughout the duration of the day. And similar comments about the cumulative build, getting pretty negative towards the close, and then seeing a little bit of a mild uptick as the Russell sees a mild uptick itself in terms of the price action. Could it be an oversold read? It's possible. If we just go back to the hourly time frame chart, it's possible that we have a daily 200 SMA reaction, equal lows from back here, and it just wasn't quite ready to go on an OPEX day. However, I'd be very open-minded to the flush of 183 into the coming week's worth of trade. If you've made it to this point in the analysis, I appreciate you coming out to the show. Do me a favor and hit the thumbs up button and subscribe if you have not already done so. Let's kick off the core list of companies here with Apple. You can clearly see that that we have a 100% retracement of this move, and now we have a lower high on the table. So as we talked about in the Friday pre-market prep, a flush of 174 would not really be all that surprising at this point in time to usher in lower prices out of Apple. This is a big time weekly lower high. It's definitely starting to come down to the wire. If we just go to a weekly time frame chart, this level is really important, right? This prior set of resistance, now that we're sort of trading underneath it, if we open that door, not only is it gap close underneath, but the stronger level of support up next is much deeper around 157, 155 on your Apple downside there. So really paying close attention to Apple. If it's going to act as a market leader, obviously downside spells downside for your S&P 500. That's pretty self-explanatory. So sweeping 174, lower highs underneath. Let's go hourly time frame chart to get a bit more granular, right? You can clearly see highs, lower highs, lower highs. All of these equal lows. If they give out, lower highs underneath 174, trade down towards 172.25. Then that gap underneath us is 170.50, closes at 167. The only time to be bullish on Apple, I would say you really need to see some sort of higher low proof over 177.85, which is the neckline of where this maybe triple top sort of resolved from in the first place. So you got to recapture that area and prove it as support. Once again, 177.85. Let's move along and take a look at Netflix. Just a horrific move, obviously, on news here. Into the Wednesday session, and it did finally sweep more firmly underneath the neckline of the prehistoric, we'll call it at this point, head and shoulders from back here. Remember that 415 gave us a lot of grief on these initial interactions back here, but we're definitively underneath it, and we actually did produce some sort of lower low. If we are going to continue lower on the daily time frame, just note that we have really thin structure back over here, maybe supports at 390.25 and 383, but overall the next big one is your daily 200 SMA and prior structure from the breakout back here at 366.25. Obviously, you don't want to be chasing this short in the hole, so what's the ideal setup? Let's take it down to the hourly. You would be looking for some sort of oversold reaction to produce a lower high, and you're fishing for shorts up against 415. Tight risk, stop here, enter here, retargeting the equal low, and if not, more follow through underneath 400. If we are going to change our tone and be more bullish, obviously it's got to be a recapture with a higher low over that 415 prehistoric neckline that we were just referring to. Let's take a look at Tesla, what's going on with Mr. Musk's rocket ship ever since breaking out of this as a balance range. Slow grind higher here, getting a couple of gap ups that never really materialized, namely on the Friday session, right? Gapping over that Thursday high, over the top of that Tuesday session as well. Just no dice for follow through. Now, it's not bearish because we are getting consolidation up and over that 268.50. So further consolidation in here just builds out a rinse and repeat of kind of this, right? We build out some sort of range. If we can take out the top, we're trading for this gap close overhead. 281 closes at 289.50. Or if we sweep the bottom, which is this area of support, we will look for a rotation through the thin structure under 268.50 to close the gap underneath us, perhaps down around 260.65, fills at 256.50. Here it is on the hourly time frame chart, just as a cleaner illustration, right? If we fail this consolidation, looking for short setups here, which get us to interact with this, and if we get some sort of move out of the balance to the upside, probably want to see a higher low over 281 to participate for higher. Next up is going to be GOOGL. What do we see on the daily time frame chart? Balance on top of balance, right? Here is your balance range. Here is the new balance range, trying to get above in the face of market weakness on the Thursday and Friday session. This actually does strike me as a positive force for the broad market. If these two back-to-back hammers can resolve higher, that would be a bullish indication. Let's take a look at the hourly time frame chart. How does this want to unfold? You need some sort of intraday higher low over 137.50. That starts to set up the context of this as a range breakout, but more importantly, you need to breach the inside bar high, which unfortunately is basically an equal high. It's very, very slight lower high on the Friday session, so over 138.50 is a bit more constructive for upside. Gap fill overhead is 139.36, closes 140.43. Beyond that, we have 143 even as a target. If the market in Google at least is going to see more of a rejection here and we sweep the lows of Friday, call it for what it is. We'll always call a spade a spade. Is this the possibility for a look above and fail? Absolutely. With the help of the broad market moving lower, you could look for a rotation closer towards 135. So broad market support is key out of Google in terms of trying to trade upside, and maybe we'll go with it to the downside if the broad market's falling off of a cliff on the failure of 137.50. Next up, Metaverse. What's going on with Zuckerberg's Fantasyland? We'll leave it off on the hourly time frame chart because this is one of the most hideous charts I've just ever seen. The volatility here is quite literally off the wall. Notice the attempted breakout, failure makes a new lower low, back up through the high, a new higher high, equal low, just pure straight up rejection of that continuation. So Nothing about this chart strikes me as being easy to watch into the upcoming week. If anything, just use this as a major pivot. If we're over 301, maybe be open-minded to bullish setups intraday, but do not overstay your welcome in the face of this big breakdown. If we're under 301, I mean, look left. Do you really want to be getting active in this choppy zone of the market? Probably not. Meta strikes me as a bottom tier setup for the upcoming week's worth of trade. It's not something I'll be focusing on. NVIDIA, what do we see over here? Strong downside move on Friday, and we've been talking about this in the pre-market preps as a boulder that we're trying to carry up the hill. This overhead supply is breaking down. This did not hold as an inverted head and shoulders. We did not get any higher low price acceptance back above 454. So with that on the table, the game plan is fairly straightforward, looking for shorts on lower high attempts underneath 445 or just straight up continuation underneath the low of Friday to close the gap all the way and then rotate through the thin structure back here down towards 419.25. I think that this one is fairly straightforward for a short if we are spending more time underneath that 454. Let's take a look at Microsoft. What's going on? We'll just flip this one back up to a daily time frame chart because I think the context here is key, tangled up around its sideways daily 50 SMA. This is much more so a range. Is this look above and fail once? Is this look above and fail twice? Absolutely. So things get a bit more dangerous now that this daily pattern has failed to really resolve higher over the 334.50. If we start slipping 329, I would be, bears on alert, and then larger downside move underneath 326.75. Noticing on the hourly time frame chart, that would be failing this consolidation and ushering in a rotation through that thin structure breakout. 319.75 once again is that target. Back to the daily chart to finish things off with, last but not least, the mini beast Amazon here. What do we see on Amazon? A failed move to really maintain the hold up and over the equal high at 143. Thursday was actually looking very, very constructive. The Friday open, unfortunately, being underneath that 143, worth changing tone back down in here. I would say that Amazon is still looking constructive overall for the opportunity to find some sort of daily higher low if we can hold on to 140. Maybe this turns into like weekly bullish consolidation that does something like this over time. We'll change our tone back over 146. If we break down underneath 140, and again, possibly looking to the broad market for support or confluence, if we break down underneath, it's a little bit of a difficult short, noting that you have lots of supports. You have the rally attempt, or I should say the open basically of Monday off of 138.60. Underneath that, you have the stronger level at 137. So there's a lot of supports underneath this. I wouldn't just be bearish out of the gates on Amazon just because of Friday's bar here. I would probably look to other names for stronger short opportunities. 3 trade ideas, and then you are on your way. First up is JP Morgan. JPM is, of course, the ticker. Notice the inside bar on Friday's session as the broad market is basically bearish. So if we can get some follow through up and over the equal highs, the inside bar high at 149.85, looking for some follow through in the upward direction towards the origin of this breakdown at 153. The reason I have 147.15 on the chart is because if we do consolidate and see a little bit of a pullback in this area, it keeps the trade idea alive, still looking for that follow through. And of course, the pattern that would be developing is some sort of inverted head and shoulders up and over the neckline, still remains bullish for a daily reversal, possibly a pre-earnings run up in the works here. Next up, let's take a look at WDC, Western Digital. What's going on over here? They make great hard drives, not a sponsorship. However, I've used them for quite some time. So I'd appreciate if the stock wanted to move higher. And that, of course, could be up and over the double inside bar setup. Lo and behold, it's a very similar story to maybe not the weekly time frame chart. The pattern's the same, obviously, double weekly inside, but it's a little bit more bullish here as you saw those daily lower wicks obviously getting bought up into the close of Friday, long over the top of this move. Cheaper price point, probably would trade this with shares. The options market is really not all that liquid in WDC, but you've got a gap overhead to trade for as a target over 43.75, target 44.35, and 45 flat as your gap close. This is off the table if it never breaks in the first place or makes some sort of lower low underneath the low at 43.15, we'll call it just for round numbers sake. Last but certainly not least is IBM. What's going on with Watson over here? Let's move back on up to an hourly time frame chart, and you can clearly see that we have ourselves the possibility of a thin structure retracement if the technology sector wants to remain weak. You have some sort of resistance trend line happening here. Totally understand that you could look at it through the lens of bull flag consolidation, but notice that we made, let's take it down to the hourly. This is where it gets very, very obvious, right? On the Friday morning session, we make a new higher high up and over Thursday's high. Why was it? Once again, always put yourself in the shoes of the buyers or the sellers. Why was it that the buyers are unable to get follow through back up towards these equal highs in here? And we close extremely weak, producing an equal low back down towards this 145.82. You can also see prior support from back down over here. If we break this after producing a lower high on the hourly from here to here, it leaves the door open for continuation lower towards 143.50. That's going to do it for today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a thumbs up. We hope to see every single one of you live at 8:15 on the Monday morning session for our pre-market prep. And with that said, I wish you a green trading week.